Most companies in the S&P 500 pay out a dividend, but a lot of those have been performing very well just year to date. We're talking double digit, which in turn has led to many of these being overvalued. So today we're going to look at a few things, but specifically at dividend stocks. Main reason for this, even those that just pay a dividend and don't increase it have been outperforming a wide variety of other stocks, and in fact the ones that really outperform are those that grow their dividend. So we're going to focus on undervalued dividend stocks, ones that perhaps maybe haven't been performing as strongly as the rest of the market, but we should also throw a bit of a spanner into the work. September is historically the worst performing month of the year. So something to bear in mind, especially when we see investor sentiment still sitting in greed, meaning that no one is really expecting a bit of a pullback. And other things to consider is that the Federal Reserve Governor believes that rate cuts not only going to be starting in September, but that we will see quite a few at the end of the year and into 2026, which makes it imperative that we look at stocks that maybe have not just runway for growth, but also that pay out a dividend regardless of the volatile situation we're in. Now the first one is General Mills, which is down 31% in the last year. Year to date, it's also been battered down. Over the last 10, you actually would have lost money if you invested 10 years ago today, but it's now sitting pretty much at a 52-week low, which could spell out a very good long-term value play. Now, we note all three analysts do give this company a hold, but the valuation is looking appetizing. We're talking forward P 13.6, below the 5-year of 16.2, at a 5-year low as well. So in isolation, we would say severely undervalued. Couple that with the yield touching the 5% point, well above the 5-year at 3.4. Both of these really telling us perhaps a great time to consider, but as always, we don't look at these in pure isolation. Now, given the yield not only very high, but well above the 5-year, we want to just look at the dividend safety score, which actually 90, very safe, is very assuring. And if we look at their growth history, not the best this year. We're talking 1.7%, below around the 4% historical inflation rate, but over both the last 5 years and the last 10 years, they have been increasing it, what we would say, in line with inflation. And whilst they've only been increasing it for the last 5 years, they've actually been paying a dividend for the last 127 without a reduction. And going to the blue tunnel to reconfirm that severe undervaluation, we see the current trading price sitting below even the bottom end of the blue tunnel, which, remember, this does within the parameters highlight the fair price. Not the greatest to see it reduce over the last year, but that is why we are now seeing a potential opportunity play. Over the last 5 years, this one actually more often than not isn't a reasonable signal. It only really became severely undervalued in the last few years, and up until the beginning of 2025, the blue tunnel was increasing. So this could be a one-off, something to consider whether we will see it pick back up. And it's also one the institutions like with their 76% ownership. They sold $3.2 billion, we're talking in the last year, buying twice as much in the exact same time frame, and they've also bought more in quarter two, $1.1 billion buying, $740 million selling. If you wanted the reversal of the trend, you'd have to go to Q4 2023. So at least in the last few years, one that institutions they do like, they are net buyers. And with each one of these stocks, we will give you our intrinsic price, which for GIS comes to $61.50. Now, when we do our deeper dives on this channel, we run through the inputs and the outputs of each one of these models. Today, getting straight to it, $61.50. This gives rise to a 20% margin of safety. Now remember, typically on the channel, we kick off with 10%. We execute buy on that if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. We're already saying for GIS, you're getting a 20% MOS. If you wanted 25, then a buy around 46. If you want a bit more at 30, then $43. So you're getting a yield touching the 5% point, a 20% MOS. Wall Street themselves seeing this at $56, in turn translating to 14% upside. The other thing we'll do is specifically highlight the DCF model for those that do prefer a singular process, not too far off at the $60 mark. We've used 4% growth rate, which is in line with their historical, and actually baked in right now, if you're adding today, is 2.1%. So it gives you a good idea as to whether you see this as undervalued or overpriced. Let us know. Stock number 1, GIS, 5% yield. buy, hold or avoid. Before we continue, we want to let you know minutes ago we have released our latest free weekly article. We draw on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market in the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a recently released copy of undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is the Kroger company. Now it is up 29% in the last year. Year to date, sitting around the 10 to 11% mark. And over the last 10 years, they're up around 99%, just marginally behind the S&P. Unlike what we saw for General Mills, it is trading around the mid to upper end of the 52-week range, but also the opposite. Rather than a triple hold, we are seeing a buy from Seeking Alpha, Wall Street as well as Quant. And we notice the forward P 13.8, slightly above the 5-year of 12.3. The yield not too dissimilar from the 5-year average, so on both accounts we could say at a first glance perhaps reasonably valued. Now the dividend safety a little bit lower than what we saw for GIS, sitting at 71. Nonetheless, it does look to be safe. And their most recent increase, also in June, a lot higher though at 9.4%, does highlight this company historically increased the dividend at a double-digit rate, and in fact they've been increasing the dividend for the last 18 years on a consecutive basis. They're sitting around 7 years away from becoming a dividend aristocrat. Now if we look at the blue tunnel, we can in fact see it is just slightly above the upper end, something we've noted for pretty much half of the last year, so this is a potential overvaluation signal. If we zoom out to the last 5 years though, this one has at times come under the severe undervaluation process. So as always, if you want high quality companies that do hit this severe undervaluation point, make sure you are subscribed, notification bell is on, because we will make you aware. Now the institutions with their 81% ownership selling $4.5 billion actually bought around 50% more in the same time frame. Only bought a little bit more though in Q2, as we noted here, around 20 million, and the reverse of the trend, you'd have to go Q4 2023. So again, pretty similar. It looks like institutions, at least over the last year and a half, have been net buyers. And our intrinsic value at $78, we can first highlight DCF slightly lower at 75, where we've used a growth rate of 10%, historically at 21, highlighting baked in is around 9% year on year to the future free cash flow. In terms of margin of safety, we're talking 14%. Some investors may like that for a dollar cost average position. If you want around 20%, we're talking a buy at $62 and at 25.58. Now, just because we have a margin of safety that is higher than what it sits at today doesn't mean it will hit there, but sometimes good just to have it on the watch list if it doesn't appeal to you straight away. Wall Street see this $78 into next year, 16% upside. Stock number 2, Kroger. Let us know your overall thoughts. We then move on to NextEra Energy, down 10% in the last year. Year to date, pretty much flat. Over the last 10, it has outperformed the S&P, is up more than 200%, trading at the mid to lower end of the 52-week range, where we get a double buy from Seeking Alpha and Wall Street. Now, we do get a double undervaluation signal, forward P below 20, not something we see that often in the last 5 years. Historically, average is 25, and yield above the 3% at 3.2, historically in the 2.4 region. Nice to see another very safe dividend score sitting at 90, and they've been very consistent with their increases, 10% this year, 10.5% over the last 5 on average, in fact 11% year on year over the last 10 years, and we get to see our first dividend aristocrat, 25 plus years of consecutively increasing it, as well as an undervaluation signal on the blue tunnel, something noted throughout the last 12 months. And actually, when we zoom out to the last 5 years, this one pretty much looking severely undervalued from 2023, but the great sign is that intrinsically it has been increasing in this period, where institutions with their 79% ownership selling $8 billion actually bought twice as much. They bought nearly twice as much again in Q2, one that they do like quite considerably, as we can see. And if you wanted the reversal of the trend, well, Q4 pretty much indifferent, Q3 a little bit more selling than buying. So one that they have liked and for quite some time. And our intrinsic value at $83 gives rise to a 13% MOS. If you wanted 20%, a buy at 66. At 25, we're talking $62. Nice upside from Wall Street. They see 85 into next year, 18%. Again, yield not too bad as well. Give us your thoughts on NextEra Energy, whether you see it as a buy, hold, or perhaps avoid. We then move into the railroad industry. Canadian Pacific, Kansas City Limited, down 7% in the last year. Year to date, up marginally at the 5% point. Over the last 10 years, sitting somewhere around the similar performance of the S&P, trading in the mid to lower end of the 52-week range. We get a strong buy from Seeking Alpha, a near strong buy from Wall Street at 4.25, as well as a forward P just below 21, historically at 23. Yield only marginally lower, although this isn't the largest paying company at 0.9% versus 0.8, and their dividend safety does sit at 76 save. Now, very nice to see 20% increase just months ago, although over the last 5 years, it has been around inflationary rate. Over the last 10, we're talking 10 to 11. And in terms of their growth, well, it was actually the first year that they'd increased it, as they had previously been maintaining it, and they've also been paying a dividend for the last 22 years without a reduction. Now, valuation-wise, on the blue tunnel, we do see it just slip outside of that point, giving us a slight severe undervaluation, although the majority of the period it has been trading in a reasonable level. Over the last 5 years, though, this one more often than not has been trading severely overvalued, so maybe a great time to consider, because when we look back to 2020, there wasn't one time until you get to 2025 where we're talking severe undervaluation, so maybe a good time just to consider if you were looking at perhaps a railroad company in the portfolio, although we have covered Union Pacific not that long ago, which is also one worthy for consideration. And institutional ownership at 72%, about 8 billion selling, 11 billion buying, so clearly they do like this. They've also bought more than 2 times as much in the most recent quarter. They did sell more though in Q3. Overall though, the trend does look to be like they have been net buyers for the majority of the period, so institutions definitely capitalizing on this company in 2025. Now, intrinsically, $82, we can highlight DCF pretty much there or thereabouts at 80.81. Now, we've used a growth rate of 12%. You can see baked in right now sitting at 11.2, but on average, all three models gives rise to a 7% MOS, not the largest that we have seen today. If you wanted 10%, a buy at 73. Price disparity not far, so we could see that during this volatile month. 20%, we're talking 65, and at 25, $61. Wall Street, though, very bullish. They see this at 20% into next year. They've got a $91 price target, but it does have the lowest yield that we are covering today. Let us know your thoughts, though, overall. Perhaps you lean more towards growth rather than dividend yield, or vice versa. We then move on to Philip Morris, which has had a very strong run in the last year, up 36%. Year to date, equally as good. Over the last 10 years, though, it's up 116%, slight underperformance of the S&P. Now, it is on a pullback from 52-week high of $187, where we get a strong buy from Quant, a buy from Wall Street, 4.17, so fairly respectable, with a hold from Seeking Alpha, and it does give straight away potential overvaluation signal, given the forward P sits at 21, historically at 16, and the yields also lower at 3.2 versus 5-year of 5.1, and another safe score at 70, where their increases to the dividend have historically been sitting around the inflationary point. If we do take a look though at the dividend growth streak, we're talking 16 years, so quite some way before we notice them turn into a dividend aristocrat. And actually we do get an overvaluation signal here. Granted, intrinsically it has been increasing. We notice disparity between upper end and the price today, and when we zoom out to the last 5 years, in fact we did see this one run quite significantly mid 2024, so if we notice it start to pull back into the reasonable signal, this could be one for consideration, but ultimately different investors have different methods. Some like to dollar cost average, some like to buy at the right time they believe is correct, and institutions with their 79% ownership selling 15 billion, again buying more at 50%, and they've also bought more in Q2, one they've been buying more for quite some time. If you wanted the reverse of the trend, we're talking around the back end of 2023. Now intrinsically, $164 does tell us you are paying a 2% premium, so no margin of safety. Now we'll highlight, as this is the DCF model, how we got to the price. We have the free cash flow year on year, average growth at 6. Now analysts do believe it will be a lot higher moving forward, so we see this a bit more conservative than them at 8%, where we have the discount rate and then the present value of future free cash flow terminal price. add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, $164, and as we said, bit of downside, trading at a little bit of a premium. Reverse DCF highlighting 8.1%, and for those that want to be more conservative, at 6%, 138, downside of 17, and those that want to be a lot more optimistic, at 10, 194, 16% upside. Now, as always, we do use the middle rate today, which is at 8%, giving rise to a 2% premium. But if you want to set a 10% MOS, buy at 148, at 20%, at 131, at 25, 123. Now, Wall Street themselves see this at 196 into next year. We're talking 17% upside, which pretty much tells us they see this growth being around the 10% point, because that gives rise to an intrinsic value of $194, not too dissimilar from their forecast. That does ultimately mean they see this right now at a 14% margin of safety. Philip Morris, let us know your views. We then move on to Coca-Cola FEMSA, ticker symbol KOF, pretty much flat in the last year. Year to date, it is up around 9%, and over the last 10 years, not the greatest, is up around 23%. But as of today, trading in the mid to low end of the 52-week range, we get a strong buy from Wall Street, a 4 out of 5 buy from Seeking Alpha, and a hold from Quant, where the forward valuation of 12.6 does sit below historical 15.4, yield not too dissimilar, and a nice safe 70 score, where their last full increase sat at around 21%, on average 9 in the last 5, 9 in the last 10, not too bad at all, and they've been increasing the dividends for the last 7 years whilst paying one without a reduction for the last 21. We also get that severe undervaluation signal as noted here, and in fact it is just below the bottom end, although the graph does look like it has been cut off, something we have seen a few times in the last 12 months. And zooming out to the last 5 years, this one has given investors quite a number of opportunities to consider when it does flag that severe undervaluation point. And we can see here institutions selling $260 million in the last year, buying more than twice that at 621, buying more than twice that again in Q2. Reverse of the trend, you'd have to go somewhere around Q1 2024. So it does look like institutional are starting to be net buyers on a fairly consistent basis. And our intrinsic value gets to $117, and that does give rise to a very attractive 27% margin of safety. If you want 30%, we're talking $82, and if you wanted 35%, around $76. Now, we will make you aware that based on a DCF, it is coming lower at $92, where we have used a growth rate of 6%, highlighting baked in today is around 5% for the longer term. Wall Street themselves, they quite like it, $106 into next year. We just saw the strong buy rating, translating upside of 25% for KOF. So let us know your views, whether you see this one as a great one for consideration. Quite a number of stocks, varying different yields, also varying different upsides. Let us know if you believe any of these were a buy, maybe a hold, or in fact an avoid. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.